Good morning, ladies and gentlemen. Well, once more, I have to apologize to you because the site is down. It hasn't updated for 3 days now, I think. But nothing much has changed. I'm following it in the background. We are in risk off in the dailies and monthlies, but that's because of the passage of time and the way the maths works. It's nothing really significant, and the market is still strong. The scores are still in the 80s, so there is absolutely no reason for panic. This will change, the maths will change, and we will go back to risk on in a few days. So I'm not in the least bothered, and I'm going to explain to you what is happening to the yield curve and how that is actually ultimately bullish for risk assets. So without further ado, let's go to the bonds. I want to start the bonds with the euro dollars and the Fed funds. Now, we've had a big move in the spreads in the Fed funds, and that is actually beginning to show what the market expects the terminal rate to be. Now, as you can see, the parts of the yield curve that have been hit hardest are basically from M22, so June 22, out to M23. And after that, the yield curve is completely flat. If you look at the differential between U23 and Z23, Z23 and H24, it's 7 basis points, 10, anywhere between 6 and 10 basis points all the way out to Z24. Now, a 5, 6, 7 basis points differential is a flat yield curve. It's the way the forwards work. And 5, 6, 7 basis points means nothing. It's flat. Where are they discounting? They are discounting basically a start in June 22 out towards M23. They're discounting something like 3 to 4 Fed hikes, which is absolutely what I've been expecting from the first moment. 3 to 4 Fed hikes starting from June, the danger being from June out to basically H23. That is when the curve will normalize. That is when the Fed will hike rates, and the market is telling you how many times it's actually going to hike rates, and after that it becomes flat. You can see in this chart of U22, which is my favorite period, how the market basically traded in a range between, let's call it 99.75 and just below 99.60. It's broken that range and it's going down. Now it's vastly oversold. So what it's going to do now is trade in a range between, say, 99.38 and 99.55. And that is a normal trading range for U22, expecting the rate hikes to come sometimes from June next year onwards. Perfectly normal, exactly what I expected would happen, and that has implications for the 2-year note and the 5s and the 10s and the 30s. So basically the takeaway here is that the market is now expecting movement from June of next year out to December to March of the year after, 2023. That is when the Fed is now expected to do its rate hikes and normalize the yield curve. What are the implications for the 2-year note? Well, the implications are that we are in a period like this. So as the euro dollars fluctuate, as I've just shown you, Basically, I would have thought that we don't go much lower than 32 now, and not much higher than, I mean, in fact, no higher than 53. That is where it's going to be for the time being, and then it's going to break higher as time approaches for the Fed hikes. And eventually, this is going to be the level of the 2-year note, around 1%. But in the meantime, the odds are that it does go slightly lower with the fluctuation of the euro dollars and the Fed funds. The Fed funds are discounting around 1% in new 23. So the 2-year note is going to be around 1% in September of 2023. It's all saying that the yield curve is going to be flat. So basically, you are looking for any kind of a pullback towards 32 in the, say, in the next few weeks to establish a short position in the futures, looking as time continues for a move towards 1%. To me, the 2s, 10s are probably the safest position to be short of on any kind of a spike. This any kind of retracement here towards 129, excuse me, is going to be a wonderful opportunity to short the yield curve. I am very, very bearish of the 2s, 10s with time. I think we will go and trade these levels around the 70, 75 area in the next, say, 6 months as the Fed normalizes the yield curve. As soon as there are any indications that the Fed is ready to start hiking, the 2-year note is going to fall apart. The 10s are going to be strong, and we will be going down towards the 65 area. You receive positive carry each and every day that you are in that position. So to me, that is the safest position to have over the course of the next 6 months when you pick your spot around 129. It's time for the other parts of the yield curve to take a rest because they have already discounted the terminal rate. So if we have a look at a weekly of 5s, 30s, we are very much entering an area where the risk reward of being still long of 30s and short of 5s is becoming quite bad. I would have thought that, we are so close to this 85 area that, 83 to 81, that it's really not worthwhile having a position in 5s, 30s anymore. And much the same really here in 10s, 30s. These markets have already discounted what is going to happen at the front end and the terminal rate. The terminal rate is going to be Fed funds somewhere around 1%, just lower than 1%, so 3 months just above 1%, 2-year notes around 1%, 5-year notes just over 2-year notes. So a flattish yield curve with Fed funds around 1% and the rest of the curve flat. That is what the market is saying the terminal rate is going to be. If that is the terminal rate, you are looking for this kind of behavior again. So basically, I think that the 30s are going to be very, very stable. 10s are going to be quite stable, and all the movement is going to be at the very, very short end as time passes by. We're entering a period of very, very stable, longer term rates. If we look at the individual tenures, and this is the yield of the 5 years, I am basically, very neutral here. I said a long time ago, don't own it until 117 basis points here, and this is basically where we are. We are, 4 basis points higher. This is very neutral. I think that we could see a period of considerable stability in the 5-year note trading around this 117 area. I certainly don't see it going any higher than 145. It's, the yield curve is telling you where these terminal rates are, and this is a very fair area for the 5-year note to continue trading in. If we look at the 10-year, which is much flatter, you can see how the yield curve has flattened. These are precisely the areas that I would expect it to trade around for a long time on largest. I would expect the 10-year note to trade around 169 for quite some time. Do something like this again. No reason for the 10s to go much higher at all. And if we look at the 30s, I think that these Bollinger Bands coming in is exactly right. You're going to see a period of trading between 2 and 220 for quite some time in the 30-year note. So you're getting a yield curve basically from 1% in overnight money to 2 to 220 in 30-year notes. That is a flattish yield curve, which gives a lot of certainty about the discounting factor that you need for equities. And to me, this is going to be the theme for the next couple of months, that the longer end is going to be very, very much in a 20 basis points range. The short end is going to basically go up and down as I described to you, but eventually break higher with time to normalize the yield curve between 1 and 2 to 220 in the 30 years. Therefore, I have to insist, I have to, explain to you again my thinking. So 5s have discounted 90%, 30s have discounted probably 99%. Everything here is already discounted, and we can probably come back a little bit in the 5s, 30s. We can come back a little bit in the 10s, 30s. To me, the yield curve is now telling you exactly where we are going to be in terminal rates. And that actually, to me, gives me a great deal of confidence in being able to price equities. Much the same thing is actually happening in Europe. This is the bubble. It's basically got to the highest level it got with the coronavirus panics. And now I expect it to basically trade sideways. These charts in Europe and in the US are very much tied at the hip at the moment. So I would expect, a range now between this minus 40 area and minus 54, and with time then Europe will catch up with the US, but it's going to take a long time. If we look at the chart of the bonds, we are basically at the highest levels we've achieved. We have a lot of resistance overhead, and I don't think that it's going to be very easy to break. So basically between minus 21 and here, this is where I expected to trade for quite some time before breaking up a little bit. It's clearest actually in France. France is the one which is reacting technically the clearest. I really don't expect us to be much lower than 8 basis points, but really I don't expect us to break these highs here around 30. A period of consolidation is what I'm looking for, and the reason why that is so is because if we look at the differential between the 10-year note in the States and the Bund, you can see that we just can't break this 180, 182 area, and we basically are stuck stuck between 182 and 165. So I expect much of a muchness in what is happening in the US to happen to Europe. So I cannot be bearish for yields in Europe at the moment, having got to where they are. I think the ECB is going to be able to hold them at these levels, and basically we're going to go sideways for a period of quite some weeks. The yield curve is basically is saying that we've discounted 99% what we need to discount, and stability in the longer end is going to be the theme of the day. And that stability in yield differentials is actually being reflected in the dollar. The DXY, and I'll enlarge this area here, you can see how on the weeklies it's the Bollinger Bands, it just can't get above the Bollinger Bands. To me, this is now a trading range between, say, 92.62 and the low 94s. I just can't see what is going to, something like this. So as I've told you, the yield curve, it's showing that the 530s has done everything that it's going to do. The 10s, 30s has done most of what it's going to do. And that, to me, indicates that there's going to be less pressure on the bunds, there's going to be less pressure on the bobble. And if that is so, there is absolutely no reason that I can see that we can't repeat a period like this, where we trade between, say, 92.62 and the low 94s. Something very much akin to that. In Euro USD, that basically equates with trading between 118 and here 115.50, something like that for the next 2 or 3 weeks. I think any spike up to 118.10, 118.40 is going to be sold hard. So that is the level that I'm basically looking at to look for a then weaker euro and stronger US dollar. That is basically, these moving averages are all moving to a bearish stance, trading between 115.30 and 118.40. Which is what, a 2% range, is to me the favored for the next several weeks. I still don't trust gold. Further I can throw it. You can see what the Bollinger Bands are doing on the weeklies, indicating a period of stability which matches the dollar and the rates. The derivative gold is basically going to stay stable, but it's going to have some nasty dips too, I presume, because the 200-day moving average, which is this line in mauve, is still trending down, and we just can't close above it. If I enlarge this daily chart, you can see that every time we try to close above it, boom, it gets smacked down. So I would have thought a period of trading between 1764 and 1820s is probably, and then coming back down is favored. I really will not own it in any kind of size until we can start closing above 1840 and turning this 200-day moving average. Nothing good happens when you trade below a 200-day moving average, and I'm still very, very skeptical of gold. That is, because the differential with DBC, you can see what DBC did last week. I'll enlarge this, and basically it closed slightly lower, but that's because it's so overbought. So I really would not be surprised by a small dip in DBC for a few weeks before it goes again. And that is really what because this chart is still the same, isn't it? The differential between gold and DBC is still pointing that eventually we go down towards 638, and that differential tells me that moves in gold are just not going to be impulsive on the upside. Not unless DBC does a moonshot, and that I really can't see it for the time being. I think it's much more likely that we trade, on a weekly, we do a little bit of a retracement here to let these moving averages move, and then we can go higher towards this 2439 area. But this is exactly where you expected the resistance to be, around around the 22 area. We got there. You can see this is the area where we had quite some trouble. We spent about a month or so trading sideways, and this is precisely where we got to, and where you can expect some sideways movement to down before we break higher again. So it all matches. Don't buy gold, don't have a big position in gold until it gets to the 1840s. It's just not going to be profitable. If we do the maths on equities, it becomes quite clear. What are we looking for? If we are looking for a bond market at the long end, which is very stable, and normalized yield curve, and terminal rates which are between 1% and 2 to 2.25% from overnight money to 30-year bonds, you are getting more and more certainty about how to price the equities. So if you say that earnings are going to be 215 and they're going to be trending upwards, as this chart shows, in that case, more or less what the discounting factor for certain, and you can start arguing whether the appropriate multiple is 20 or 22 or something in between. So what the upper edge, and we're in this fourth quarter where a lot of money is going to come into the market. What is the highest you can see the market trading at? Well, I really can't see it trading higher than 22. Okay, I don't think that a multiple of 22 higher than 22 is warranted by any stretch of the imagination. So 22 times 215 is 4,730 up here. And what is the lowest multiple? Well, it's going to be somewhere around 4,300. So we have a 4,300 to 4,730 trading range. That's basically it. Will the market, the more certainty we have, and as time passes over the next 2 or 3 weeks, and the bonds do exactly as I said, and 30 years are in a 10 to 20 basis point range, and the yield curve normalizes, and we are not looking for any more than what the market is looking at the moment in terms of rate hikes, we should be tending to go up towards the 22. But if we stayed around the 21, which is 4,515, would I be shocked? No. And this is really what VIX is saying, that the low level of VIX, that we are getting more certainty about the range for the next several weeks. I think that from a weekly standpoint, whether we do a small retracement here for a couple of weeks, the situation is pretty clear. The market will want to push towards year end, towards these higher Bollinger Bands, and that level of 4,730 that I indicated to you just now, which is 22 times the forward earnings. I think we are very overbought, and it would be normal if we just basically did something like this again. And, I really don't expect us to see any lower than 44.26 from now on until the end of the year. I think any dip now here towards 44.80 is going to be bought hard, and I'll want to double up on my long option position there. But that is that is basically what the maths is saying. The more certainty of the terminal rate, the more certainty we get as to how to price the equities. And really, I think it's whether we get a dip first or we keep on going up, I don't know. But I really would not bet against 4,730 before year end. If we are going to get to 4,730, we really need help from NASDAQ. And at the moment, we're not getting it. It has to become a leader again. And at the moment, with all the trouble that's happening with Facebook and Google because of the advertising and Snapchat and all this stuff about the Apple privacy changes, that is going to give us some pause. To me, it's critical that we don't break below this area, which is 4,992 to 4,938. If we can maintain this gap, then at some stage we will be ready to break the all-time highs. But we really do need help. Until NASDAQ helps the S&P, the S&P can't really go much higher than it is doing at the moment. The other sectors are rotating, yes, but we really will need the full-fledged help from NASDAQ to get to 4,730. If we look at the tech spreads, okay, so XLF to XLK, this spread is only to me going to go up towards these levels, 0.27, if we get a bearish XLK, i.e. what I'm saying is XLF to me has done everything it's going to do. To me, XLF for the next 1, 2, 3 years is dead money because the yield curve is where it should be. And it's done 90% of what it's going to do. And now as the Fed hikes rates, actually what's happening is that the differentials that XLF depends upon are coming in. They're not going out. So anybody who is going to be buying XLF because the Fed is going to be hiking rates is actually going to be very, very disappointed. To me, XLF now is going to be dead money. I just don't want to know about it. I don't want to look at it. I don't have anything invested. I still have JP Morgan because I've always said JP Morgan and will always have JP Morgan. But that doesn't mean that I want to be overweight XLF. I want to be overweight the sectors that are going to be benefiting from a strong economy because the Fed hikes into a strong economy. And that to me is going to be XLI and other sectors in even XLK. To me, it's very telling that XLK over SPY is doing very, very little on the downside. That to me says that as time passes, the odds of us making new all-time highs become greater and greater. And that is why I'm having more and more confidence of seeing that 4,730 by year end and XLK joining in. It really has to. XLK is the same as NASDAQ, is the same as the QQQs. It really has to help. And I really hope that at some stage in several weeks, we have the help from XLK. Well, certainty provides a lower VIX. The certainty of the terminal rates provides a lower VIX. And here we are with a lower VIX. If the VIX was at 20, I would be worried that my analysis is not correct. But I think that we are now in a period of lower spikes in the VIX, i.e. we have lots of little gaps around here, this 1880 level. We have one even up here towards 2088. But I think those are going to be brief things that basically the market says what this chart of VIX is telling me, that any day that you get a 30, 40, 50 point drop in the S&Ps, it'll get bought. So that gives me more confidence that those levels that I gave you earlier around the in the low to mid 4400s are going to be the lows now in the S&Ps. And then, you know, we are probably going to go down in a few weeks' time and trades around the 12s in on the weeklies. If I enlarge this, you can see that basically then we will be in a new range between 1228 and 1550. And that gives me confidence that by year end we see that 4700, 4730, 4750 area in the in the S&Ps. If I enlarge this chart, you can see that basically since the coronavirus, we've never really been lower than these levels. We closed one day lower, but I think now we are going to basically be stuck between the very, very low 20s and somewhere around 13 and heading towards 12.5. So that is also saying that the more certain the terminal rate, the lower the VIX can be. As you know, I'm going to be away next week, and so I think the safest trade is going to be looking for any kind of a bounce in 2s10s to short. That to me is going to be the trade for the next 6 months. You know, the short 2s10s on a nice bounce. I think 5s30s and 10s30s have basically done 99% of everything they're going to do. I think it's almost 100% discounted that we will have tapering in November, which is bullish for the yield curve. And I think that the flattening of the 2s10s will start happening in December, January of next year, the real flattening. And I think over the course of the next year, 2s10s are going to flatten down into the 70s. But, you know, it's a great position to hold because you get positive carry. So you get paid to make money. So to me, that is the safest position to hold. I think all the other bond markets are now going to show increased stability and lower volatility because we are reaching the level that the market, the terminal rate that the market is saying we're going to achieve sometime towards the second half of 2022 and maintain. That gives me more confidence that these dips to these levels are buys in the S&Ps. And basically next week we have resistance at 4570, which is the weekly Bollinger Bands, and I really don't expect it to go much higher than that. So with VIX doing what it's doing, any kind of spike towards 20 is a sell, and that gives me confidence that these levels are going to be bought. I don't think NQ is ready yet because we have these individual problems within the biggest stocks in NQ. So I think it's likely to do some retracements, but those retracements are also buys. Thank you very much indeed. Keep safe next week. I'll try to tweet if I possibly can, but as you know, I'll be with my children and grandchildren, so I probably won't be looking at the market very much. Keep safe, and I'll do another video next weekend. Thank you.